Welcome back, everybody, to another deep dive. We love to dig into some really cool investing books. And today we're going to be digging into one called The Options Wheel Strategy.
The Options Wheel Strategy.
It's published by Freeman Publication.
Freeman Publication.
And they claim that you can get steady 15 to 25% annual returns with their conservative options trading strategy. So we're going to dig into this book today and see if we can pull out any gems. But just right off the bat, no guarantees in the stock market.
Of course not.
Always do your own research, understand the risks involved.
Yeah, one thing that I thought was fascinating about this book was that they almost, I felt like they were pushing back against options hype.
Okay.
It's not about getting rich quick. It's about building wealth slowly, methodically.
Right.
Kind of like Warren Buffett with options.
Yeah, I was surprised to learn about how much Warren Buffett actually uses options.
Oh, yeah.
So anyway, okay, let's get into it. Let's talk about what is the wheel? What are the mechanics behind the wheel?
Yeah, so the wheel is all about selling cash-secured puts and covered calls. And it's this cyclical process where you're potentially generating income from multiple different sources. It's not just isolated trades. You're building a process. You're selling puts, maybe acquiring stock at a discount, and then selling calls on that same stock.
Gotcha. So instead of me just explaining what a cash-secured put is, let's jump right into kind of the unique angle of the book. They talk about using these cash-secured puts specifically to acquire undervalued stocks.
Right. It's not just about collecting premiums. It's about saying, hey, I want to own this stock. I want to get it at a good price.
Yeah.
And we'll use AT&T as an example and say,
Yeah.
okay, I want to buy AT&T, but only if I get it at $28.50. So what I'll do is I'll sell a put at a $28.50 strike price, and I'll collect 60 cents per contract.
Okay, and that's where the cash-secured part comes in because you need to be ready to buy those 100 shares if it drops below $28.50.
Right.
But what they're saying is, hey, you're not just buying any stock. You're only doing this on companies that you've already vetted.
Exactly. You're only selling puts on companies that you'd want to own for the long term.
That you would be okay owning.
Yeah.
Okay, so let's say you've now acquired some shares of a company that you like through the cash-secured put process. Now what do you do?
Now you can sell covered calls.
Okay.
So a covered call means you own the stock and you sell this right for somebody else to buy it from you at a certain price.
And what are the different things that could happen when you sell a covered call?
One thing that could happen is the call could expire worthless and you keep the premium.
Okay.
The other thing that could happen is the stock price could go up and the call could get exercised. So then you sell the stock at that strike price.
Okay.
You get that money, and then you also keep the premium.
But is it always that simple? What about situations where like a stock, like, I don't know, like an Nvidia or something just skyrockets?
Right.
Wouldn't you miss out on a lot of those gains if you had a covered call in place?
That's a great point. And it's something that the book addresses pretty directly.
Okay.
They actually ran a back test on Apple stock over a 10-year period. And they compared a wheel strategy to just buy and hold Apple stock.
Yeah.
And guess what? The wheel underperformed.
Wow, that's pretty convincing evidence that wheel is not like this magic bullet for every stock.
Right. It's not for growth stocks.
Yeah.
It's not for volatile stocks. It's for those boring but reliable companies.
So it sounds like stock selection is super important when you're doing the wheel. They even say to avoid it on like Amazon, right?
Right. Yeah. They say that for a couple reasons.
Yeah.
One is that Amazon options premiums are actually pretty low compared to the potential price appreciation.
Okay.
So you'd be giving up potentially huge gains to collect a relatively small premium.
Okay. So you've got to choose your stock really carefully.
Yeah.
How do you actually choose where to place your cash-secured puts and where to place your covered calls? They talk a lot about technical analysis, and I know that can be kind of scary for some people.
Yeah.
But what are they saying about technical analysis?
They start with the concept of support and resistance.
Okay.
Which is essentially identifying areas on a chart where the price tends to reverse.
Gotcha. They use examples like AT&T and Lennar to show how you can identify those zones. And if you're not comfortable drawing those support and resistance lines yourself, they recommend a free plugin for TradingView.
Oh, nice.
Created by a user named Lonesome the Blue.
Okay.
So pretty cool.
Yeah.
But they also say, don't just rely on one indicator.
No.
You've got to use multiple tools, like Bollinger Bands and Mass CD and RSI to confirm your analysis.
Right. It's like getting a second opinion or a third opinion on your trades.
Okay, so technical analysis helps you identify potential entry and exit points.
Right.
But how do you assess the overall market environment? What about the VIX?
Yeah, the VIX is like the fear gauge for the market.
Right.
It's measuring expected volatility.
And higher volatility usually means higher premiums, which can be kind of tempting, but also higher risk.
Yeah.
So what are they saying about the VIX when you're doing the wheel? Do they give like specific numbers to pay attention to?
Yeah, so they say that you should generally stick to stocks with an implied volatility between 30 and 50%.
Okay.
And if you're brand new to options, they say don't even trade at all when the VIX is above 30.
It's like checking the surf report before you go surfing. You want decent waves, but you don't want to get caught in a tsunami. The VIX helps you gauge that risk.
And it's not just for entries. You can also use it for exits.
Okay.
Like if the VIX spikes, you might want to think about exiting a trade, even if it's not profitable.
Makes sense. Okay, let's talk about options Greeks. I know this can be kind of like a scary topic for people,
Yeah.
but they focus on the two that are most relevant to the wheel, delta, and theta. What is delta?
So delta is the probability of an option expiring in the money.
Okay.
So for example, if you're selling a put with a delta of 0.30, that means there's about a 30% chance that you're going to have to buy the shares.
Okay, and what about theta?
Theta is time decay. So as an option gets closer to expiration, it loses value.
Gotcha.
And theta is the rate at which that happens.
So as an option seller, you're basically collecting rent on that option.
Right.
And theta helps you maximize that rent.
And they actually recommend selling options that are closer to the money because those have higher theta.
Okay.
Even though it feels riskier,
Interesting.
you can actually collect more premium that way.
It's about finding that sweet spot between risk and reward. So you've talked about choosing the right stocks. We've talked about technical analysis, the VIX, these options Greeks.
Right.
Now, how do you actually execute the wheel? How do you put all these pieces together?
The basic steps are pretty straightforward.
Okay.
You choose your stock, you sell a cash-secured put,
Yep.
you monitor the position, you decide whether to roll or get assigned, and then you sell a covered call.
Okay. And they actually have a free P&L tracking spreadsheet on their website.
Oh, nice.
That's really helpful for keeping track of everything. So a lot to think about here. And that is it for part 1 of this deep dive on the options wheel strategy. Make sure to come back for parts 2 and 3 where we dig in even deeper.
Yeah, we'll see you next time.
See ya.
Bye, you. Welcome back to our deep dive into the options wheel strategy.
All right, so in the last part, we kind of got into the basics of the wheel, how it works.
Yeah.
Now I want to talk about what happens when your account grows. What happens when you want to start scaling up?
Yeah, that's a good question, and it's something that the book addresses specifically.
Okay.
They really emphasize that scaling up doesn't just mean throwing more money at the same trades.
Right.
There's a strategic way to approach it.
Okay, so how do they recommend scaling up the wheel?
Well, the first thing they talk about is diversification.
Okay.
So as your account grows, you want to gradually add more positions.
Gotcha. So instead of just concentrating on a couple of different stocks, you
Yep.
start to branch out.
You spread your risk across different companies, different sectors.
Makes sense.
But then they get into something that I thought was really intriguing.
Okay.
They talk about having multiple brokerage accounts.
Okay.
So it's not just about diversifying your holdings.
Right.
It's also about diversifying your brokers.
Interesting. Why do they recommend that?
Well, they say that if one broker experiences any kind of issues, you don't want your entire portfolio to be affected.
Gotcha. So it's like having a backup generator for your investments.
Exactly.
That's interesting. Okay, so let's say your account gets really big. Do they still recommend the wheel at that point?
That's where the book gets really interesting.
Okay.
They suggest that as your capital reaches a certain threshold, you might want to consider transitioning some of your holdings into more traditional buy and hold strategies.
Okay, so the wheel might be more appropriate for the earlier stages of building your portfolio.
Right. And then as you start to get more capital,
Yeah.
the power of compounding returns
Yeah.
from those long-term investments starts to become more appealing.
So it's almost like graduating from the wheel into something more passive.
Exactly.
Okay. One thing I really appreciated about this book is how much they emphasized avoiding margin.
Yeah. Margin is a big no-no.
Yeah, it's like they're saying, look, we're trying to build wealth steadily and safely.
Not gamble with borrowed money.
Exactly. Now, even with a conservative approach, the wheel can still introduce some volatility into your account.
Oh, for sure. Yeah.
Right, because you're dealing with options. Those assignments can kind of make your portfolio jump around a little bit. So what do they recommend for investors who are a little bit more risk averse?
Well, they talk about alternative options strategies.
Okay.
That might be a better fit. They mention credit spreads as a good option.
Okay. And a credit spread, just for anyone who doesn't know, is where you're buying and selling options at the same time.
Right.
So you're creating kind of a defined risk and a defined profit range.
It's a little bit more complex than just selling a naked put or a covered call.
Yeah.
But it can be a good way to manage your risk more tightly.
So it's like dipping your toes into the options world without diving headfirst.
Exactly. And it's all part of the journey of becoming a more well-rounded investor.
Okay, so your account is growing, you're diversifying, you're getting comfortable with the wheel. What are some things to keep in mind as you start scaling up your trade sizes?
Well, one thing they talk about is the importance of managing your entries and exits carefully,
Okay,
especially when you're dealing with larger orders.
gotcha.
They talk about the impact of large trades on the stock price, particularly for those less liquid stocks.
Right.
It's like the difference between placing a pebble in a pond and dropping a boulder in a pond.
That boulder is going to cause some ripples.
Yeah, exactly.
Okay, so what are some specific strategies they recommend?
Well, one thing they emphasize is using limit orders,
Okay.
both when entering and exiting a position.
So that way you're not getting filled at a price that's
Right.
way worse than you expected.
It helps protect your profits from those sudden market swings.
Okay, what about stop orders?
Stop orders are like having an emergency exit plan.
Right.
So if the stock price drops below a certain level, your order automatically gets triggered.
Gotcha, so it's like a safety net.
Yeah,
But even with all these tools and strategies, the wheel does have its limitations,
it does, yeah.
especially when you start talking about really large amounts of capital.
Right,
So they're not saying that the wheel stops working at that point.
right.
It's just that there might be other approaches that are more effective.
Yeah, and they even suggest that splitting your accounts as you get more capital
Mm-hmm.
not only helps with scalability, but it also further mitigates that brokerage risk that we were talking about earlier.
Okay, now I know some people might be thinking about reverse wheel strategies,
Yeah.
where you're selling calls on a stock that's falling.
Yeah, trying to profit from a downward move.
Does the book talk about that at all?
They do, and they're pretty cautious about it.
Okay.
They point out that reverse wheel strategies can be really tough to pull off consistently.
Yeah, it's like trying to paddle a canoe upstream.
Exactly.
Right.
And remember, the market tends to go up over the long term.
So it's generally easier and more profitable to align your strategies with the overall market trend.
Right. You don't want to be fighting the tide all the time.
Okay, so in this part, we've talked about scaling up the wheel. We've talked about some alternative approaches. We've talked about some of the limitations.
Yep.
But there's still more to cover. Make sure you come back for part 3, where we'll wrap up this deep dive into the options wheel strategy.
Sounds good.
Welcome back to the final part of our deep dive into the options wheel strategy. So in parts 1 and 2, we've covered, what the wheel is, how it works,
Right.
some strategies for scaling it up. But now I want to talk about kind of setting yourself up for success with the wheel. And they talk a lot about the mental game.
Oh, yeah.
Like, it's almost like they're prepping you for a mental marathon.
Yeah, it's easy to get so caught up in the technicals and forget about the psychological aspects of trading.
Right.
And they emphasize how important paper trading is.
Yeah.
And not just for beginners,
Right. Yeah.
but even for experienced traders.
Right.
Like, test things out on paper first.
Yeah, it's like training wheels for your trading strategy.
Right.
Right? You get to kind of test out different scenarios, see how you react under pressure,
Yeah.
and refine your approach without risking any real money.
They even suggest, keeping a trading journal
Yeah.
to track your decisions and analyze your results.
So it's not just about placing trades, it's about becoming a more mindful and deliberate trader.
And the book goes even further, too, and says you need to dedicate time
Okay.
to really studying the market.
Okay.
Reviewing concepts, analyzing charts,
Okay.
really, correlating these different things like the VIX with options deltas.
So you've got to build that foundation of knowledge
Yeah.
before you even start paper trading.
It's like learning the rules of the game before you step onto the field.
Exactly. Okay, so you've done your research, you've got a good mental game, you're ready to start trading. What about earnings announcements?
Oh, yeah.
That can really throw things for a loop.
That's another area where the book offers some good advice.
Okay.
They say you need to plan around earnings announcements.
Especially for stocks
Yeah.
that tend to have big price swings
Yeah.
after the news comes out.
So, maybe you avoid selling options
Yeah,
that expire close to an earnings announcement.
gotcha. Or maybe you make sure you have enough cash
Right.
on hand to cover potential assignments.
They even suggest, diversifying your portfolio in a way
All right.
that avoids having all your wheel positions reporting earnings at the same time.
That's really smart.
Right.
Because that
Yeah.
way you always have trades in
Yeah.
motion.
You're spreading your risk across the earnings calendar.
Okay, let's talk about weekly options.
Oh, yeah.
The book mentions these as a potential way to kind of generate more frequent income.
You get that theta decay happening faster.
Right.
But they also come with some caveats.
Okay, like what?
Well, one thing is that weekly options expire every Friday.
Uh-huh.
So you've got to be a lot more active
Right.
in monitoring your positions.
It's a faster game.
Yeah.
Okay.
So they recommend starting slowly,
Okay.
maybe just one contract to get your feet wet.
Gotcha. And they really recommend closing out those positions on Friday.
Yes.
To avoid any surprises over the weekend.
Yeah, those weekend volatility spikes can really hurt.
It's like locking in your profits before the market has a chance to change its mind.
Right.
Okay, so we've covered a lot in this deep dive into the options wheel strategy.
We have.
We've talked about mechanics. We've talked about scaling up the mental game.
Yep.
But the book ends with a final thought-provoking idea that I
yeah.
really want to highlight.
Okay.
It's not just about mastering the wheel.
Right.
It's about using the wheel
Right.
as a springboard to become a more informed and confident investor overall.
Yeah. And that's the real journey here.
Right.
The wheel is a great tool, but it's just one tool in a larger toolbox.
It's about continuous learning and growth.
Yep.
Well, that's it for this deep dive into the options wheel strategy. We hope you learned something new.
Yeah.
We hope it gave you some ideas to think about.
Definitely.
And we'll see you in the next deep dive.
See you later.